So the S&P 500 is on track for its 5th straight month in the green. Despite many of the negative fundamental issues within the economy and bank collapses and record rate hikes, markets have continued to grow and grow and grow, and week after week, more bears are capitulating. In fact, few are even hedging against the potential downtrend anymore. Quote, buying protection against dips in the options market is the cheapest you likely have ever seen, Bank of America strategists wrote. Why is it so cheap? Well, because nobody's buying protection right now. Everybody expects the markets to continue to go up. And folks, when you don't use protection, you might end up having to pay for that mistake for up to 18 years. Quote, sentiment trader suggests the shift may endure. Unlike in the past, corporate insiders are big buyers, while technicals like subdued volatility and bullish options are keeping equity sentiment elevated. Why are corporate insiders buying? Well, a lot of this insider buying is in the tech world. And big tech players are buying expecting their companies to see outsized profitability or at least outsized allocation in this AI race. In fact, ChatGPT alone itself has been so groundbreaking that China is now making their own competitor, ChatCCP. But there's also more to this story. The market is giving us a clear signal that bullish momentum has been building. There's an incredible level of confidence that the Fed can manage a soft landing with weaker growth and lower inflation without a recession. But if something goes wrong, it will be related to that. Now, will the Fed ultimately be able to manage the so-called soft landing that we've been talking about the last year plus? Well, with rates at 22-year highs, it's quite frankly hard to imagine that nothing else breaks. And we know that monetary policy has quite the lag. Usually about 12 to 18 months. You raise rates and then 12 to 18 months later, you start seeing the effects of that. So quite frankly, what we're seeing right now are the effects of what the Fed did 12 to 18 months ago. So when you're looking out 6 to 12 months from now, it's really difficult to say that things are actually going to be better instead of worse. And in fact, just this last Friday, it was announced that Kansas Heartland Tri-State Bank was closed by the FDIC. Now, of course, this is a small bank, but if we're continuing to see banks fail, what does that mean? These are all banks that have fallen within the FDIC's regulatory standards. And yet they're failing even with those regulatory standards. So as these rates continue to roil through the economy, are we going to see more breaking or are we going to see more improvement? Well, you can let us know your predictions down below, but it is also true according to Fortune that over the past 30 years, September and August have been the two worst months for the S&P 500 with a 0.4% drop in the former and a 0.2% drop in the latter on average. However, it's worth mentioning that if you had looked at historical data all this year, you had looked at fundamental data dating back to the 1920s, and you compared that to the data now, and you made a conclusion based on that, you would have been wrong. So this time around, you might still be wrong if you're looking at this data. And to make this even more ironic, even without a massive recession, higher bond yields themselves tend to be a big double whammy for stocks. On the one hand, 5% plus rates make stocks a lot less appealing for investors. At the same time, those high rates make borrowing costs extremely expensive for corporations, cutting into profit margins. But in this market, neither of these things have derailed the massive rally in stocks. And so you always got to remember that the stock market is a business, and when Wall Street sees opportunity for profit in buying and driving the markets higher before the next rug pull, well, that can create very long-term trends that can be very lucrative to trade off of. And remember, what matters for traders in a market is not so much predicting. What matters for traders is riding the correct trend and readjusting when the trend breaks. I like to look at the market as you would an individual stock. If the market is trending up week after week without significant breakdowns, just marginal breakdowns, well, then you can keep playing that momentum confidently. But once it drops 5 to 10% in a consolidated period, well, that's all of a sudden a situation where you might want to start activating your mental stop loss and readjusting accordingly. If the momentum regains, you could always re-enter, right? A lot of folks don't realize that a lot of money in the market is made not predicting the move, but playing the current move that you have and then readjusting when it breaks. Because net over really any month horizon or any couple of month horizon, the market is moving in one direction or the other. So if you're always trying to predict the change of direction day after day after day, well, you're probably not going to be very accurate. Remember, the trend is your friend until the trend bends, and then the trend is no longer your friend. Okay, moving on, let's talk the latest on plays and what is working right now. We'll start with IFBD. So our IFBD top idea hit a low in the pre-market Friday at 0.89 cents and then ran to 148 at highs towards the end of the day. That's about a 66.2% run to highs. It actually managed to run well above the previous peak from a week prior, and we made a full breakdown on this stock on Thursday as an AI catalyst stock with a ChatGPT integration and an arbitrage opportunity between assets and liabilities. And this stock fit the characteristics of a lot of other stocks that have run massively, and so far, the stock has had some pretty damn solid rallitos, which makes Charlie Charlito very happy indeed, and hopefully grew a lot of Wally Wallitos. This one was a really solid idea because it had hours and hours of entry zones that provided people who had this on their radar with pretty large large tradable opportunities. This stock has carried on the tradition of finding very, very solid top trade ideas that have real arbitrage opportunities and or a real catalyst. Now, if you want to keep up to date with our latest top trade ideas and all trade ideas, and we have a lot of exciting ones coming out this week, make sure to sign up for our completely free email and text alerts with that first link down below. But anyways, with this, for tomorrow, the main thing I'm looking for is retention. If IFBD can hold the 105 support or at worst the 96 cent support, perhaps that would be enough proof of concept to see this break into another new cycle high past 148. If it can't retain those levels though, the momentum might be dead until the next wave, and that is how a good trader looks at a stock. If the stock is not providing the proof of concept that you need, well, you should avoid it until it does. Alternatively, like in this situation, if it's providing some proof of concept and you play the move, but then it's no longer providing that proof of concept, well, you should leave. And vice versa. Proof not promises. You want the stock to prove to you that it has potential to continue rallying, but you don't want it to just promise, because promises are empty. So Tuppy Tapito Tupperware has gone full-blown Squeezy McGee, climbing from 61 cents to 375 in roughly 6 trading days, and that is what they call in the South a fun time. I mean, I'm not from the South, but I imagine that's what they call a fun time. If you're from the South, you can let me know below. But oof, what is going on with Tupster? Well, Ortex estimated short interest in green has been climbing consistently this year, and as the price has gone up, shorts have been increasing their bets. Short interest in the last 7 days is up about 13%, which means that as the price has gone up, shorts have tried to maneuver it back down by dumping more and more shares they don't own. And when you see this kind of rapid increase in short interest, it has a very, very similar impact to a stock price that an offering does. It's just that you don't get a big press release. This is essentially trading tons of shares out of nowhere and selling them on the open market, right? And that has a hugely restrictive effect on a stock's rally. But unlike offerings, shorts, at least at the end of the day, have to, at some point, buy back those shares, which means that as the stock price rallies, they get put into a worse and worse and worse corner. If TUP continues to break out the next few days this week, do not be surprised if shorts start slowly reversing their bets and you see some big buying pressure coming from those who had previously shorted it massively. Shorts right now know that squeeze speculators are relentless, and there's only so much exposure you can have to a squeeze stock that's going parabolic before you start freaking out and reversing your bets, and I think we're going to see that pretty soon if this momentum continues on for a few more days. Next, I want to conclude this video with earnings that are coming this week, and the stocks on this list that are reporting earnings that are likely to have some outsized moves based on the implied volatility that we are seeing. You've got the 5 of the so on Monday. On Tuesday, you've got Norwegian Cruise Line, Uber, Pfizer, Caterpillar, Merck, JetBlue, Sun Power, AMD, Starbucks, Pinterest, MicroStrategy, Virgin Galactic. On Wednesday, you have CVS, Kraft Heinz, PayPal, Shopify, Qualcomm, Unity, Robinhood, Mercado Libre, Etsy. And on Thursday, you have Wayfair, Expedia, Moderna, Hasbro, Cigna, Regeneron, Amazon, Apple, Coinbase, Block, Airbnb, DraftKings, Cloudflare. And you are concluding the week with Fubo, Nikola, Fisker, Magna, and Frontier. And of course, the big dogs of this week are going to be your Amazon and your Apple. Amazon, we haven't heard much out of them for quite a long time. It should be real interesting to see what they're going to do, because you saw what happened with Alphabet. Very, very quiet. Analysts had very, very low expectations. All of a sudden, massive beat. Amazon, a little bit less interesting, but they do have some real potential in terms of Amazon Web Services and how that is going to be utilized in order to further progress AI. And there's a lot there that you can do. But in terms of trading opportunities and high implied volatility, you're going to want to watch specifically your PayPal, your Shopify, your AMD, your Robinhood, Coinbase, DraftKings, and Fubo. Anyways, folks, that caps off today's video. I hope that you found value in this video. If you did, make sure to hit that ravishing like button and subscribe, and make sure to hit that notification bell too, because we got some big content coming this week. Have a good one, folks, and we will see you in the next video.